Welcome back, investors, to Ticker Time News. I'm Adam, and it's shaped up to be a pretty good day for the bulls, all things considered, right? The session started with a gap down after market participants digest a generally positive November employment report. The employment report featured stronger than expected non-farm payroll growth of 263,000, higher than expected average hourly earnings growth of 0.6%. And a unemployment rate that remained unchanged at 3.7%. So it held pretty steady. Now, looking at the heat map here of the S&P 500, still a lot of gray on here. Microsoft looks like it did exactly what it did yesterday, hardly moved at all, up 0.13%. Amazon still down big like yesterday of 1.4%. Apple, which you can't see, my head is blocking, but it was down 0.34%. So a lot of gray. Tesla up 0.08%. So a lot of gray on the map, a little bit of red, a little bit of green. So all things considered, it wasn't that bad of a day for the markets. Now, let's hop over here to the stock chart for the S&P 500, looking specifically at the ticker SPX. I think, and I'm going to get my highlighter here. I think what we saw right here, okay, I'm going to box this in right here, okay, this time period, okay, where we had a big rally, a big move higher, okay, and then we spent a while consolidating. All right, just moving sideways. You go up 1%, you go down 1%. Just up and down, up and down. I think that's what we are looking for right now. We had a big move on Wednesday. And then Thursday and Friday, we really just moved sideways. So I think what's going to happen is the downsloping trend line like this, okay, and this upsloping trend line that has carried this rally this far are going to meet. Oh, excuse me. And they meet precisely. Let's see right here. If we go to Friday, they meet precisely Monday, December the 12th. So between now and Monday, December the 12th, so all of next week, we can move sideways. Up a little bit, down a little bit, but move sideways. That could be what is in the crystal ball, okay? The crystal ball that I don't have. That's what it could be shaping up to be. And then, of course, in this point, this triangular point right here, something is going to happen. Either we're going to get enough momentum to break above this trend line and really accelerate this rally, or we're going to break down, okay? And we're going to fall. Now, I want you to notice something here on the screen with today's move, all right? The candle is green, but the S&P was down, okay? It was down 0.12%. So not by much. It was almost back to the flat line. Now, go down here and look at the volume for today. Right about here. It's underneath the median. Okay? It's underneath the average volume. So we got 2 billion trades today on the SPX. Right now, and I got to move this a little bit so I can see it, the average is 2.3 billion, okay? So about 360 million trades less today than average. And whenever you have a big move of momentum to break a resistance line or even break a support line, you need momentum to do that. And right now, with today's move, being below the average, that's not momentum. So I think today's trade was very mixed, right? It wasn't bad. It wasn't good. It was just right? Now, if you caught this morning's dip and you bought that and you wrote it into the close and then sold off, well, that may have worked for you, okay? That may have worked. But overall, this is not a strong move today, in my view. Now, sellers definitely stepped up their efforts on the heels of the release, since the report itself was good news, at least from an economic standpoint, that is. Yet, the market saw the employment report today as bad news. The thinking goes this report will push out any eventual, let's call it, pivot by the Fed. And I don't like using the word pivot because the Fed's not going to pivot anytime soon. But the market didn't like this employment report because it was decent. It was pretty good news. The market desperately wants the Fed to pivot. The market thinks that if the Fed pivots, then we're on for a rally of the lifetime, a rally of a lifetime. That's not going to happen. Now, let's look at the Fed funds rate here real quick, just to give you a visualization. If you're on TradingView and you go Fed fund, all one word, okay? This will show you the Fed. Okay, where did it go? Okay, there we go. This will show you the Fed funds rate. Now, I'm going to take the moving averages off because that doesn't matter here. What matters is how steep and how quickly the Fed funds rate has gone up. I mean, look at this. It's like a straight line going up. The Fed has raised rates aggressively. We've looked at this before, and we've talked before about how it's typically like stairs going up, where they raise it a little, maybe they let a couple months go by, they let an FOMC meeting go by, and then they raise it again. Not this year. This year, the Fed has been running fast and hard. Now, the report today, the employment report, to me, that report screams higher for longer with respect to the target Fed funds rate. Just as Fed Chair Powell and other Fed officials have suggested for months now that they are going higher for longer. Now, I know the narrative that's in the market right now. You see the headlines. The Fed is going to pivot soon. Even other big YouTubers, I won't name any, but there's one particular big YouTuber saying that the Fed is nervous and the Fed is going to pivot soon. No, I'm sorry. I do not agree with that. The Fed will not pivot in 2022. I know there's only one meeting left, but I've been saying that for months. We will get a Fed slowdown in the pace of rate hikes, but we will not get a Fed pivot. Even in 2023, the Fed will continue to raise rates. I think closer to the 5% mark. And right now, you can see the Fed funds rate is at 3.78 right this second. So we're already over halfway there to that 5% mark, we're real close. Not quite there yet, but we are over halfway. And as rates continue to go up, this market's going to continue to go down. No, I don't have a crystal ball for the exact timing of how and when this market will go back down, but we are in a bear market, and this is a typical bear market rally that we are in. We are just getting to the point of the bear market rally. As I tighten up the screen here, you can see we're at that point where we typically hit the resistance and we drop back down. But this market and the narrative in the market is taking what they think is a pivot or a pivot coming soon, that the Fed is scared and shaking in their boots and they'll have to pivot soon, as what will actually happen. But this happened in mid-August also. Remember, in mid-August, the whole summer rally was a front run to a Fed pivot. Did the Fed pivot in August? In September? No, they didn't. Remember that? You remember, go back and watch our live streams from July, August, when we were in this rally, especially the first and second week of August, as we were getting closer and closer to this downsloping trend line. The narrative then was the Fed is going to pivot. The bear market is over. But the market got rejected at that trend line. The same thing here. It's just now there's one thing that's a little bit different from the summer rally. Okay. I see your point there. This smells just like last time, and it does. This rally, that is. It does. There's a lot of characteristics to the last rally, the summer rally, to mid-August to now. There's only one thing that's different. The one thing that's different right now is market participants pretty much agree on the Fed is going to raise rates by 50 basis points on December the 14th. Now, they're not sure how the market's going to react to this, because they have other YouTubers telling them that the Fed's going to pivot and the market's going to go on a rally. I can pull up a tweet and show you. Now, that's why I think we're getting these jitters here at the trend line. While we went up, we tagged it yesterday. We briefly intraday went above it and then closed back below it. And then today we get a gap down and we move up. We get close to it, but we pull back at the close. There's a little bit of hesitation here, because when you take into account that December is typically a positive month for the markets with a Santa Claus rally. I mean, we have that name for a reason. We don't always get one, but we typically do. I mean, going back to the chart that I've showed you guys multiple times with, which one is it? It's right here. Nope, that's not it. Did I close that one out? Let me do. Yeah, I guess I did. No, there it is. I just couldn't see it. This chart, the red line, is what we've been following for this year, right? Because this matches up with the midterm election cycle year going back to 1946. December is typically nice. And even when you take into account all the other Decembers right here, December is typically a positive month for the markets. But you can go back to 2018 and see we had a big fall. Inflation was rising. The Fed was raising rates in 2018. Something similar to now, okay? So I just think the market is just getting a little bit ahead of itself right now, thinking that the Fed is going to pivot when it's not. The Fed is going to slow down their rate hikes. Now, the Dow Jones, which is ticker DIA, S&P 500, the SPY, and the NASDAQ, the QQQ, they were down 1%, 1.2%, and 1.6% right out the gate this morning. So significant drops. And the S&P 500, it did breach its 200-day moving average at 40.46. Its 5-day EMA is also at 40.46. So there is support at that level. But that did get broken through, right? It was breached earlier in the morning. But buyers got back involved following that breach and brought the S&P back above that key level where it fluctuated for most of the day. Things slowly improved, however, with about 90 minutes left to go as the S&P 500 refused to drop back below its 200-day moving average. And as interestingly, the correlation stayed connected today. Treasury yields continued with a sharp reversal this afternoon from their post-employment report highs. The 2-year yield, it got up to 4.38% earlier today and then settled at 4.29%. The 10-year did the same thing. It hit 3.6% and then it fell to 3.5%. And even the US dollar, ticker symbol is DXY. It did a similar move today. It was up as much as 0.8% following the employment report this morning, but it ended down 0.2% to 104.5. Now, it is a half a point below that important 105 number, but as you can see on the chart here for the dollar, what we really got to watch for now as support is this old level right here. It was resistance here. It was support here. And it's somewhere around 103.7 to 104.2. Okay. If the dollar breaks that, the markets should go higher. But if the dollar finds support in this area, the markets should fall. Now, the correlation, it did not break today. It held true, which was something I was concerned about yesterday because there was something not right in yesterday's market, but it got fixed today. Now, it is notable, though, that the IWM, which is your small caps, it actually closed with a 0.6% gain. And the DIA, which is for the Dow Jones, it made its way from that 1% decline all the way back to the break-even line. So that was a good thing. Okay, I see it. See your comment. I want to pull it up here. A little off topic, but how do you scan and play your trades before the market opens? Well, TradingView has a scanner. You got FinViz. They have a scanner as well. And there are a bazillion ways that you can use these scanners to find trades to play. Now, I like playing the main indexes and using leveraged or inverse. Like, let's go here for example. SPXS. If this is the direction S&P 500, it is 3x leveraged. So when the market goes down, I should say, when the market goes down, this goes down 3 times as much. Today, if we look over here, this was up 0.43%. Did I say that backwards? I did. When the market goes down, right, SPX or the S&P 500, when it goes down, this goes up. I said it backwards. Now, SPXL, when the market is rallying, it will go up 3x as much. Okay, so we have that. I like to play those. Okay, we also have on the Q side as well, you have these inverses that you can play. Where did I? Yeah, there we go. I don't use pro shares as much, but it's S and then the triple Qs. So if you think that the Qs are going to go down, SQQQ is the inverse that you would play. So it was up 1.3% today as the QQQ was down 0.4%. Okay. So I like to use these ETNs or ETFs because they play just like them to see what's happening. But I prefer using the main indexes as to play individual stocks at this point in the game. Okay. Right now, trying to pick a stock is hard to do. It's a lot easier to play the indexes or the market because if you know what sectors are moving, what sectors to pay attention to that have heavy weights, like technology has a big weight for the S&P 500, it's easier to play the index level right now. Once we get back into a bull market, that will change. Then it's a whole lot easier to go and find some winning stocks and move kind of away from the indexes, right? Even though I always love playing the indexes. But for TradingView, when you're on the chart, down here on the bottom left corner, you can open up their scanner. You can scan for anything that you want to, literally. And then FinViz would be the other one, FinViz.com. That would be the other one. And you can actually go in FinViz. You can search for go into their scanners. You can actually search for specific chart patterns, which I like to do that as well. So FinViz is a good one, and TradingView has their scanner. But I'm looking specifically for chart patterns, not necessarily earnings or what other companies are doing. I also want to keep liquidity high and market cap high. Those two are important. If you don't have liquidity, it's tough to trade it. If it's got a good high liquidity, it's got a good high market cap. Those are two things that I look for before going in and looking for the actual chart pattern. But I've talked about these quite a bit before. Don't want to rehash it too much at this point. But again, these things are so to the T right now that you can really narrow this down for whatever you are looking for. Okay. So, okay, just to give you an example right here. If we go over to the left, so on FinViz with the screener, underneath the top section where the little boxes are, down here, descriptive, fundamental, technical, all. I want to go in the technical box, right? And then the filters to apply, okay? You can go in here to performance. How has it been doing? I'm clicking any. Right here's the 20-day simple moving average, right? Do I want it close to that? Yes, I do. Something close to the 200-day moving average. You can go above, you can go below, you can do anything you want. 20-day high low. You can go with 50-day moving average. I like that too. 200-day. Things below it, above it, go for it. RSI change right here is pattern. And when you click on that, you've got a bunch of different patterns to search for. They all are really nice. I like wedges. I like triangles. There's so many different options here. It's really tough to to go through it. But let's just say wedge, okay? And we'll make it strong wedge. We just went from 1,000 stocks or more down to literally 4, all right? Price is 10% below its simple moving average, and it is wedging, okay? Now, with this right here, you can click on which one you want, or just by hovering over it, you get to see the chart patterns here. And this one looks good. IDRA. It's got a nice one. Not so much on this one. And then you want to make sure that it's got a decent market cap. Really, 100 million or above would be like the lowest that I would go for. So the Ideal Pharmaceutical, which it was starting to move up there on this wedding pattern. They're like, but market cap, we got to fix that. And just tap market cap, and it's going to change that for you. But getting into an entire tutorial to go through and really answer that. I like chart patterns the best. And if I can go through and find the chart patterns that I'm looking for, oops, I went the wrong way with this one. That's much better for me. So FinViz or TradingView, use those, no worries. You got to read headlines prior to. That is also important because headlines can change up everything when it comes to a stock. I also tend to stay away from earnings days, especially in a bear market like this, because there can just be so many variables that you can't control or account for when it comes to earnings in a bear market, that I'll just stay away from that. No, thank you. Not for me. So a good point there about the headlines too. That's a good one. Okay. I wanted to get into this just a little bit here real quick. I don't have a lot for today. It's Friday. I normally don't. But I would like to say that the S&P 500, it did stay within its weekly expected move today. It closed right in it. But what I want to talk about real quick is 2023, okay? FactSet had a report come out today, and the title is Larger Cuts Than Average to EPS Estimates for S&P 500 Companies for Q4 to date. And basically what it's saying is that analysts are coming out and they are lowering their EPS estimates for S&P 500 companies. And this was through September 30th through November 30th. The companies themselves aren't doing that. So with this article in mind, and I will pop up here, okay, and I'm going to share this with you guys. I'll just take out all the garbage URL tracking that these companies do. I'm going to share this link with you guys in the chat. So if you want to go read this, you can. It is definitely worth a read this weekend because it gives you a good insight on what analysts are doing about the earnings. So going into 2023, it's kind of hard to see a market trading at 17.5 times calendar year 2023 earnings as trading at a true value, given the economic warnings that we all see. I mean, the writing is on the wall. We have a Fed that is still intent on raising rates up to 5%. And knowing that many companies have yet to issue fiscal year 23 earnings guidance. Think of all the earnings calls where companies 2023, we don't know. And they don't give an answer for that. That guidance will start to flow in late January during the fourth quarter earnings reporting period. And I'd expect to hear a lot of cautious sounding guidance, mainly due to economic conditions, macroeconomic environment. Those forces will bring estimates lower. So how low will they go is the $64,000 question. Analysts in this report from FactSet are already marking down Q4 earnings, but the answer on 2023 will depend on not just how weak the economy gets, what China does with its zero COVID policy, what Russia does with its war in Ukraine, and what the Fed does with its monetary policy are all some of the wild cards for the growth outlook. And they can be game changers for the stock market, for better or worse. 2022 has been a major struggle for the stock market, and it's not over yet. Fortunately, December has, as I showed you with the chart, has a good reputation for typically bringing a good month for the stock market. So perhaps a bad 2022 can end on a high note. But I have 2018 to look at to give me pause. Now, the stocks will still have their share of struggles in 2023, presumably more so in the first half of 2023 than the second half, as deteriorating economic conditions collide with inflated earnings estimates. Nevertheless, we expect the economy to have a bigger struggle in 2023 than the stock market for several reasons. Now, we're going to go into those reasons in our deep dive with our Saturday note that we published for our private investor community. And then I'll talk about them next week in a live stream after you guys have a chance to look over it. If you would like to get it, just click the first link in the description. We'd love to have you. Now, with 2023, we could break this trend line for December. It's not looking likely, but it is a possibility. And looking forward on December 14th, I didn't put a marker here. I did on others. Where's that signpost? Let's do this. Let's go to December the 14th, which is not that far away. Right there. Market. All right. This is going to be FOMC. Not that far away, right? Absolutely incredible. And notice here too, the FOMC meeting, let me move it down. Oh, come on. There we go. Notice the FOMC meeting on the 14th. That occurs after. It occurs after this triangle point right here, where the market's going to have to make a choice on where's it going, what's it going to do, right? So I'm curious. I think things are just adding up where the market right now, it looks at, well, December's typically a good month, so why not rally? Or they say the Fed is going to pivot, so why not rally? Have a ton of things. Maybe it's possible that what happens is we break above this trend line, but then on December 14th, that's when the hopes and dreams of the rally ends. Or maybe we just continue moving sideways to that point and go and slide down this trend line until we get to that December 14th FOMC meeting. Okay. That's all I have for today. So if you have any questions, throw them in the comments. I'll be happy to go over them. Otherwise, it's a Friday. Obviously, I try to keep this light and fluffy and not go too crazy on what to cover today. But that's everything that I have. I'll give you a minute or so to put any questions or comments that you guys have in, and then we'll wrap it up for Friday. I have a pretty detailed note going out tomorrow for our private investor community, talking about 2023, talking about valuations. They're still too high. And if valuations at companies are still too high, that means they're going to come down. And if those valuations come down, so is the market. And I'm going to put it out there with the receipts, I guess, as the term would be as well, to back up what I'm talking about with the details that goes out tomorrow. We're seeing consumers go crazy with credit cards. Oh my goodness, the usage of credit cards is not a good sign. It's not a good sign for this economy. This economy, on the surface, you know, I'd probably say the economy on the surface some may say looks good. The economy's healthy. Everything is okay. The economy is fine. However, under the surface, it's not that great. Now, the employment report, it was strong. It was decent. Okay. And as long as that holds up and that's strong, then it's going to take some extra time for a typical recession to hit, potentially, if things stack up the way they are. I mean, look at all the tech companies that have been laying off, or freezing their hiring plans. I mean, it is just crazy. Plus, earnings estimates have not come down, as I'll prove tomorrow. Earnings estimates have not come down like they should have. Okay. Yeah, we do need to see jobs come down. Let's see here. Did I miss a comment? Do you think earnings might not be as bad this time again? No, I think they're going to be rough. Analyst, with the report that I shared in the comment section from FactSet, analysts are marking down earnings estimates for Q4 right now. And those Q4, that'll be reported in late January. And the interesting part will be their forecast on 2023, because a lot of companies didn't give 2023 forecasts. So it'll be interesting to see how that part of earnings plays out, right? You have the earnings part of earnings, and then you've got the forecast part. How are things going to look next quarter or for the year ahead? So I do think earnings are going to come down. They'll be a little worse than last time. At least that's my take on it. I really think the projections are what are going to hurt the most with earnings. Let's see here. Okay. I think I think I got my comments mixed up here, and that's why they seem a little backwards. We technically need to see job cuts in order for people to finally slow down. Yes, that is true. And with the employment report that came out this morning, the market went down not because the employment report was bad, but the market gapped down because the employment report was good. It was still strong. And for us to go into an actual recession, we need to see that employment rate go from 3.7 to 4 to 5, and then we get to 5 and greater. That's causing some pain. But another thing too is people can only go so high on their credit cards, right? They can't just use their credit cards and put an indefinite amount of money on it. There is a limit. And if that limit is met and they're still not trying to cut costs or raise their income, that can hurt them as well financially, which then can hurt the financial markets. Let's see here. Just trying to make sure I get all of your comments. Sorry I'm late. No worries. No worries at all. Can you please review CRM? Sure. They just had earnings report. That's Salesforce. CRM. Let's pull that up for you. All right, let me fix the chart. Look at that. For the past 3 months, it's gone nowhere. So they reported $1.40 for EPS, which was a 15% beat, or 18 cents, on $7.8 billion, which was almost in line. They beat by nearly $10 million. Now, Salesforce has fallen, but you can see they've kind of stabilized here for the past 2 to 3 months. Salesforce is an interesting company, right? Because what do companies need? Companies need sales. They need revenue. And Salesforce is just the way for companies to manage their customer list, their contacts, their emails. I mean, it does a lot, right? It does a lot to help companies that lean heavily into sales. But if you look here, we can draw a line. I know my line is not very straight, across there and then across here. And really, it's gone nowhere for nearly 3 months. Up, down, up, down, up, down. What Salesforce needs to do in order to really break out is to get back above this line right here where it was rejected, rejected, rejected. And prior to that, it did hold as support at least for 2 sessions. And that starts, where would this be at? Right about 164, 165. So 164 to $165 a share. That's the resistance that Salesforce would need to break. But it lost a lot with this earnings. Why? Because of its forecast going forward. Okay. Down 8.27% today. Not because of, oops, I got my highlighter on again. Not because of these earnings. No, it is because of their forecast. Drop after a downgrade for Salesforce. Salesforce falls as that's downgrade on growth, other issues. Salesforce spinning out. Let's see here. Spending data sends equity searching for direction. Yeah. Why Salesforce shares dropped 8% Thursday. The boss is leaving the building. Oh, yeah, they're getting a new CEO. Pressures the Dow. So, who was it? Mark Benioff? Was that the name of the CEO for Salesforce? Him leaving is a big deal. And whenever you have a change of leadership at a company, investors get shaky. Investors get nervous and worried, especially if the CEO is being replaced by somebody new or not well known. Okay. And that can cause sell-offs too. So we've got those two things hitting. So let me pull this one up right here, as we can see. Let's see here. Do they have co-CEO? Oh, no. This is Brett Taylor, the other CEO. Would leave the company at the end of January. The move was seen as a surprise, as Taylor, who had been with Salesforce for 6 years, had only been sharing CEO duties with Mark Benioff. Yep, I was right about him. Since November 2021, when Taylor's officially leaves Salesforce, Benioff will become the company's sole CEO. Along with Taylor's departure, investors weren't too impressed with Salesforce fourth quarter outlook. That's it right there. That's the name of the game, in which the company forecast earnings above analyst expectations, but gave a revenue estimate that potentially falls below Wall Street's predictions. Yeah, that's what it's about. And in the note that's coming out tomorrow, it's going to talk about that. It's going to talk about, well, in Q4 of 2023, why do you think companies have a reason to up their earnings estimates? They don't. Right now, everything is pointing to earnings estimates are too high, valuations are still too high, meaning this stock market is not done falling. Earnings estimates will fall. And Q4, I think, will be that tipping point where maybe this is one scenario that Q4 earnings at least kind of hold up with expectations. But just remember, expectations right now for companies in the S&P 500, analysts are lowering their Q4 estimates right now, okay? They're lowering their Q4 estimates. So, with that said, if companies meet estimates that were dropped or lowered, does that make the company better off? Does that mean the company performed better? No, it doesn't. But it may make market participants seem like the company did. So that's why the forecast will be so important when they report at the end of January in 2023. This is worth reading. It is very, very interesting. If you look right here, estimates for Q4 for all companies in the index, which is the S&P 500, it decreased by 5.6%. Right there. Decreased by 5.6% for earnings estimates. All right. These aren't companies doing that. These are the analysts, their expectations for how a company is going to do. They're lowering them for Q4. To me, that says that Q4 earnings aren't going to be as good as Q3. Okay. Let's see. Any other questions that we can dive into? Otherwise, we will